Hello and welcome back to part 4 of our discussion dealing with job order costing. Up to this point, we pretty much covered pretty much all there is to know about job order costing, right? We did an overview. We know that we can trace our direct costs. We know that indirect costs need to be allocated. They're allocated based on the predetermined overhead rate. We saw how to calculate that predetermined overhead rate. We also discussed how to apply that overhead rate. In this video, I want to discuss how do we use multiple predetermined overhead rates. So after you complete this video, you should be able to not only compute total cost, you should also be able to compute unit product cost of a job using multiple predetermined overhead rates. Now, like I said in the previous video, if you understood what we did in video 2 on how do we calculate that single predetermined overhead rate, this will be easy, okay? There is a little bit of a hitch, so to speak, when it comes to applying the predetermined overhead rate, because we got to make sure that we apply the correct rate to the correct job. So let's dive right in and let's look at a quick example here. We have a company that has basically two production departments, assembly and milling, okay? This company is going to use job order costing, and we're going to compute the predetermined overhead rate in each department. So that when we say we're going to use multiple predetermined overhead rates, usually each department is going to have their own rate. Okay, so they give us information for the milling department, and they give us information for the assembly department. Each of these departments has a different allocation base. Okay, now let's think about this logically, right? Milling, assembly, right? Usually you're milling, if you're not familiar with, milling, basically it's using a machine to kind of, cut wood, shape it, whatever, right? So the milling department is probably going to use a lot of machine, right? Their overhead costs, their total overhead, or their total manufacturing overhead is going to be driven by those machine hours, because they use heavy machinery, or not heavy machinery, but they use a lot of machinery there. Okay, the assembly department, well, that kind of entails person putting something together. And if we read the problem, they say that the assembly department is based on direct labor hours. Well, that makes sense, because the assembly department probably has a lot of manufacturing overhead that is incurred based on labor, right? Based on indirect labor. So what we can do then is we can use the cost plus pricing to price out, or to price out our products, right? So think about it this way. The pricing cost method basically says we're going to mark up whatever, we're going to determine our selling price. That selling price is going to be based on how much it costs us to produce or provide a service, plus some percentage. Okay, so in this example, they use a markup of cost plus 75% of total manufacturing costs. Okay, that's how they get their selling price. So they give us information for the beginning of the year, right? For each department, milling, they use 60,000 machine hours, assembly uses 3,000. Direct labor hours, milling uses 8,000, assembly uses 80,000. The total fixed manufacturing overhead, well, we got 390,000 for the milling. Assembly has fixed MOH of 500,000, and they provide us the variable overhead per machine hour for milling and for direct labor for the assembly. Now, let's think about this conceptually here for a minute, okay? Previously, we used a plant-wide overhead rate, right, which was one rate, okay? So, based on our two departments, so we're going to make a product and it has to go through both departments, okay? Our total manufacturing overhead is all the fixed manufacturing overhead, all the variable overhead per department, okay? Would it make sense to do one plant-wide rate? And hopefully you said the answer is no. Here's why. The reason why is because whatever allocation base we use, whether it be machine hours or it be direct labor hours, one department is going to incur more of a cost than the other department, meaning we're going to allocate more cost to one department than another department. And here's what I mean by that. If we base manufacturing overhead based on direct labor hours, right? That's not a good allocation base for the milling department. Why? Because what drives the costs in the milling department is the machine hours, not the direct labor. Okay? So there's going to be more cost there, right? Because we're using a lower denominator, right? Assembly, we have 80,000 units or 80,000 direct labor hours, right? So that's going to have a smaller amount of cost allocated to it. Why? Because of the numbers. Let's work through an example here, okay? So first thing we got to do when we're using multiple predetermined overhead rates is we got to calculate the overhead for each department, okay? So notice what we have here in the middle in the blue, right? Just look at milling department. 390,000, that's the fixed. $2 per machine hour, that's the variable cost per cost driver. And then the 60,000 machine hours, that's the activity of the cost driver, right? Y equals Y, which is the milling department, equals A plus B times X. Total cost 510,000. We do the same thing for the assembly department. Fixed costs plus variable cost per unit times quantity of the cost driver. Okay, so we have two total manufacturing overhead costs. The next thing we need to do is allocate or calculate the predetermined overhead rate. How do we do that? Very simple. We take the total overhead cost for each department and divide it by each department's allocation base. Okay. Same exact thing we did in video 2. The only catch is we're segregating. Okay, this department has these costs, that department has those costs, this department has this driver, that department has that driver. Very simple. Then we actually have to then go ahead and calculate the amount of overhead that we're going to apply from both departments to the job. So we have job 407, right? Job 407 has a total of 94 machine hours. 90 of those hours come from milling, 4 of those hours come from assembly. Direct labor hours. In total, this job incurred 25 direct labor hours, but because each department requires different inputs, milling department only utilizes 5 direct labor hours, where assembly utilizes 20. Okay, they provide us the direct material cost that each department puts into the product, as well as the direct labor cost that each department applies to this job. Okay, so we're actually going to have two, or we're going to have to allocate the predetermined overhead rate twice based on each department, right? So the milling department, if we take 90 machine hours, which is what the milling department incurred, they get 8 point times the predetermined overhead rate of 8.5. We get 765 of allocated costs going towards the milling department. The assembly department, we have to allocate overhead from that department, 20 direct labor hours times $10 per direct labor hour, 200. Excuse me. So we can now calculate the total cost of this job. Direct materials. We can easily trace these, right? Milling department incurred $800. Assembly incurred $370. In total, for this job, based on those two departments, the total material cost was $1,170. Direct labor. Well, direct labor cost was $70 for milling. Direct labor cost for assembly was $280. So in total, this job went through two departments. We, as the company, based on these two departments, applied $350 of total labor cost. Manufacturing overhead that was applied. Well, the milling department applied their overhead cost based on their overhead or predetermined overhead rate, which totaled out to be $765. Assembly. We also needed to apply manufacturing overhead from the assembly department because the assembly department incurred indirect costs to make this job. The milling department incurred indirect costs in their department to apply to this job. So the total manufacturing overhead applied was $965. We add up those totals of direct material, direct labor, manufacturing overhead applied, we get $2,485. Okay? So, how are we going to calculate the price? Very, very, very simple, right? We know we're using cost plus markup. Well, what cost? Well, we're using the total manufacturing overhead cost incurred, right? So, the cost for job 705 was 2485. That is our total cost. We're going to add, or we're going to mark it up 24%, or I'm sorry, 75% of the total cost, which is 2485. The markup is $1,863.75. So what should we price this job out at? Well, it's going to cost somebody who wants the purchaser of job 407, it's going to cost them $4,348.75. We see that selling price, that's revenue to us. We just earned $4,348.75 by incurring a cost of $24.85 to produce this job. Now, if you look at the paragraph below, take a couple seconds and read over that. Now, what is this saying, right? It's important to understand that if we use a plant-wide predetermined overhead rate to get the selling price, our costs are going to be different, right? Direct material and direct labor are still going to be the same because those are direct. We can easily trace those. The problem, or the inaccuracy, if you will, comes from how we apply manufacturing overhead. If we used one single plant-wide rate, right, either basing it on the direct labor hours or the machine hours, we're going to have a different rate, okay? So why then would we want to use departmental predetermined overhead rates, right? The reason why is because they're more accurate for us, right? We can more accurately account for our costs that we incur based on, the jobs, right? So by using multiple predetermined overhead rates or departmental predetermined overhead rates, we as managers can make better decisions, and we can prepare better plans. Okay. Um, this predetermined overhead rate, excuse me, we're going to see activity-based costing. There's a chapter on that. Activity-based costing is actually chapter 7. So keep in mind that this predetermined overhead rate, it's very important now that we understand it, that we study it, because when we come to chapter 7 and we look at activity-based costing, we're going to look at a number of predetermined overhead rates, and we're going to look at activities. Okay, and we'll talk about that when we get to chapter 7. The real takeaway here is that by using these overhead rates based on activities, right? We're using direct labor as our allocation base. That means that we have a lot of indirect labor in our manufacturing overhead, or we're using machine hours, which means we have a lot of machinery costs or indirect cost based, or yes, indirect cost surrounded by machinery. Okay, so the takeaway here is this is sort of an activity-based costing, sort of. We're going to see what activity-based costing really is and how we calculate activity-based costing, and how we create, or how we identify our cost pools and our cost objects and whatnot. Again, talk about that in chapter 7. Okay, but just keep in mind the takeaway here is recognizing that we have to calculate a number of predetermined overhead rates. Now, since we're applying, right, we already said there's going to be inaccuracies. Why? Because we're estimating. We're allocating all this stuff based on estimates. Okay, so we're either going to under apply or we're going to over apply. Okay, well, what does that mean? Well, think about it this way. If we over apply, that means our estimates were too high. We actually applied more overhead than we actually incurred. Okay, think about it from the reverse standpoint, right? What if we under apply? That means that our estimates were too low. Okay, our estimates were too low, and we applied less than we actually incurred. Okay, that's when we under apply. So very important takeaway, you understand the difference between under applied and over applied, and identifying, well, what happened, right? Well, if I under applied, that means I didn't apply enough. I didn't apply enough overhead, and at the end of the period, I still have costs that I didn't account for, right? Over applied means, hey, guess what? I accounted for too much costs that I actually incurred. Okay, and excuse me. How do we fix these? Well, very simple. If we under applied, that means that we did not account for costs, right? We still have costs that need accounted for. We need to increase our cost of goods sold. Okay, if we over applied, we have to decrease our cost of goods sold. Okay, so basically what we just did here, what we talked about, we went from managerial accounting, saying I'm going to cost this out. Okay, I'm going to account for the costs. I'm going to look at my manufacturing costs. Did I apply enough, or did I apply not enough? Okay, then we switched gears and we says, hey, how do we fix this? Oh, we got to talk about non-manufacturing costs, right? We got to get away from period and product costs, and we got to, or let me rephrase that, we got to go towards product and period cost. which is the classification for financial statement purposes. So we went from manufacturing versus non-manufacturing, which is our cost classification for manufacturing, and then we kind of looked at it through a different lens, which we learned back in chapter 1 for financial reporting purposes, period and product costs. Okay, so we said that, hey, our manufacturing costs, we either underapplied or overapplied. How do we fix it? Well, we got to go to our period costs, and we got to change, or I'm sorry, we got to go to our cost of goods sold, which is on our income statement, and we have to adjust them there. Okay, so forget period costs. They're all manufacturing costs. We're just going from manufacturing costs for manufacturing purposes to product costs for financial analysis purposes or financial statement purposes. Okay. Don't worry about the job cost sheet subsidiary. It's just basically all the job cost sheets that we have. They basically we store them, so to speak, in what we call subsidiary ledger. Don't worry about that. Work in process and finished goods. We'll actually get into that more in chapter 3. Okay, so don't worry about the cost of goods sold. We'll discuss a lot more in chapter 3 about the underapplied and overapplied. Just for right now, you need to know this slide right here, this information, when overapplied or underapplied occur. You need to know that, and you need to know how do you fix it. Okay, meaning underapplied, we got to increase cost of goods sold. If we overapply, we have to decrease cost of goods sold. So those are you got to know those 4 things, so to speak. Okay, so real quick review. We did talk about multiple predetermined overhead rates, and we saw an example of how to calculate them. It's basically just taking the plant-wide approach and applying it to each department, right? Looking specifically at the fixed cost within a department, the variable cost per unit within the specific department, as well as what is that driver, and recognizing that each department is going to have a different cost driver and each department is going to have a different predetermined overhead rate. Okay, we will work on some examples of this in our next video. In your study guide, if you'll notice, you do have some practice problems. We will go over those together and actually apply these concepts that we talked about. So again, if you have any questions, please feel free to reach out to me. Again, I welcome text. It is totally not a problem. So thank you very much for tuning in. Turn back into our next video where we cover the examples from the study guide.